I look at the data. Wages are hot, 4.7% in the first quarter. The CPI above trend, and the services inflation is also hot, and the three-month average is far from where they really want to be. My question to you is this: should they really be cutting?
Hi, Manes. First, I'm with Allianz, even though we own PIMCO.
My apologies.
On behalf of Allianz. I think the reason for cutting is threefold. The first is recession risks are higher than inflationary risks. Yes, services inflation is sticky, and yes, wage data is a bit picking up, but there is no wage price loop. And at the same time, we really see the sluggishness of growth once we have a bit less fiscal support. As you know, it's the big story of consolidation. Second, I think it's amazing that the ECB graduates. It's not a teenage central bank anymore. They can take their independence from the Fed. I think that's going to be a massive signal, and I'm quite happy about this. I was a big skeptic on that point because I think the financial cycle is really US focused. We see that everywhere in the correlations among assets. So if they do that today, that also shows a real political independence, because remember, we have elections later this week, and the others may not have done that. And the third reason is very clear. I do think that the path ahead is very gradual. So even if they cut now, we expect still 2 cuts this year. So it's going to be cut, pause, cut, and the terminal rate's only of 2.5 next year. So it's still quite, I would say, still a very conservative monetary policy. And this is really something that is in tune with, I would say, the determinants of growth in the Eurozone today.
That conservatism that you say, and I like the analogy in terms of a teenager, political independence, a spirited mind of their own, detaching from that symbiotic relationship with the Fed. I don't think it's broken, but I think it's a lovely way to portray it. But you talk about the propulsion for rate cuts being much more aggressive in 2025, which then makes me wonder, well, what is so malevolent in 2025, Ludovic?
Well, then the Fed will have started to cut. That is, if Trump doesn't come back and makes a big reflation, from protectionism and discrediting the Fed, right? So that is a very central scenario. But yes, I think the last stronghold, the last bastion, is indeed to make sure that the ECB is not too ahead of the Fed. So that's where the graduation of the teenage years is a bit so important. I think in 2025, by then the Fed will have a bit more forward visibility on its own loosening cycle. And then the ECB can get to a rate cut cycle or pace of 25 basis points almost at each meeting. That's how they get to the 2.5. I think what markets are pricing in right now is a bit cuckoo, if you pardon me. Like the more than 4% terminal rate in the US is unheard of with 3% growth, and something in the tune of 3% terminal rate, in the Eurozone is also unheard of. So I think they're going to come to their senses, and we do believe that 2.5 is an okay terminal rate for the Eurozone, and that means, a much more cadenced rating cut cycle in 2025 indeed.
What a wonderful way to describe the mispricing in markets, cuckoo. So if we are mispricing the perception of the terminal rate, then what else are we mispricing in the rates market?
That's a good question. I'm often a bit on the edge when it comes to the idea, and you've seen what happens right now. The fiscal policy is very central to everything that is going to be priced in the coming months. So I'm a bit concerned about how markets welcome the fiscal news, especially the fiscal profligacy news. As you know, we are going into a moment where we're going to have this debt sustainability analysis coming from the Commission. We're going to have the excessive deficit procedure list. So I'm a bit worried that some people get antsy or get a bit concerned about the Italian fiscal trajectory, the French fiscal trajectory, and so forth. So that's concern for mispricing on the rate market today. Yeah.
So how sticky is, the debate that I was having with, not debate, Lizzie was sort of proffering the idea about the sticky inflation in Europe relative to the stickiness of inflation in the United States of America. And a lot of this stickiness comes down to the intransigence of energy as well in the component parts, as well as housing. So how sticky, if I look at the break-evens, they are beginning to roll down both in the US and in Europe, and we can talk about the seasonality of break-evens. But the trajectory of break-evens is coming down. Does that embolden the narrative that inflation is not as sticky as we're writing about?
That Lizzie was right. I mean, a lot of people are going to look at staff projections today because in every model that I see, including ours, we see this very sticky services inflation part, which is historically not happening. So we see in every model now, if you look at monthly or quarterly modeling of inflation, you have 1.5, even sometimes 2 percentage point of services inflation, and all the rest is at zero, even contributing negatively. That doesn't exist, right? So there is a bit this idea that there will be no gravity for services inflation. I tend to disagree with that. Of course, the good news is second part of the year with a bit less inflation and still wage growth, you're going to have positive real income effect. But keeping this 1.6, 1.7 percentage point of services inflation all through the horizon of forecast is not possible. So I think the break-evens are actually coming to the realization that, of course, services inflation is going to start to, the pricing power of this services company is going to start to wane down, as, of course, they cannot continue to have such a good ride as they've had over the past 2 years when it comes to putting a full transmission of their price and the cost to the customers.